Smart money react to the price. Dumb money try to predict it. The chart is naked and we don't understand how and why a market is moving a certain way, so we must clarify, and we do that by analyzing it. From the left of it, at its beginning, we're seeing a quite small bullish impulse. But what's important is the fact that it started from a low and went into a high. From this high, the market pushed down below the last low. So if the last low breaks down, that means that we've got a lower low. We got the first important detail, and that is that the lower low is a swing point that is met on downtrends. On downtrends, we're seeing swing points of lower lows that are then followed with lower highs. But instead of having the lower high, the price actually pushed even higher, broke the last high, and formed a higher high. This is where most get stuck and don't understand if they should look for buy setups, because the higher high is a swing point of an uptrend, but also they don't know if they should look for sell setups, since we also got a lower low, and that's a swing point of a downtrend. Dumb money will force setups, while smart money wait for the market to print more swing points. They just wait for the trend to be precise, and it's only then when we can react to what the market is doing. For example, if we just wait, we will see that the market pushes down from the high and breaks below the last lower low, creating another lower low. So with patience, the trend becomes easier and easier to read. So we have two lower lows and one higher high. The downtrend is currently having the edge. The downtrend has swing points of lower lows that are then followed with lower highs. And we see that from this lower low, the market pushed to the upside on a pullback, this pullback ending below the last low, so it has finally validated the first lower high swing point. Now the swing points are both coupled on the same trend, which is a downtrend, and we know that because the lower low was followed with a lower high, and then from that lower high, the downtrend continued by breaking down below the last low once again. So again, having a bearish formation of another lower low swing point. Basically, the market is constantly repeating this pattern of lows that break down and highs that end below the last highs. Now that we know this pattern, we just react to it. The market comes up with a push to the upside. And because we know this market is following a downtrend, since all of the previous highs were forming lower highs, what do we expect from this next high? Should it also end lower and create another lower high? Or should the market break above the last high and create a higher high? It really depends if you're trading against the trend or trading with it. In most cases, trading with the trend is a lot more simple. Trading with the trend in this case would mean that we also expect a lower high, since that is what has already happened before. So it makes no sense trying to predict the moment the trend changes. So downtrend continuation means that we expect a lower high. A lower high means that the market can't break above this previous high. So this last upside pullback should end somewhere below the last high, below this line. We can't know the exact level, but that's when supply levels come into play. The pullbacks that form a lower high will often end on a supply that was taken from the last high. The price is also currently sitting inside of that supply. So if we don't expect a higher high, that means that we can plan a sell setup from the bottom of this supply, with the stop loss above the last high, again, with the expectation that the last high will not break. And the take profit is quite simple to plan. Notice how each time we had lower lows, so it makes sense to plan a similar formation again, with the take profit below the last low, in hopes of another lower low formation. So, after hitting the supply, the price starts dropping. Now the chances are that this high validates as the lower high, since it becomes more and more unlikely that it will break before breaking the low. So basically we expect the low to break down first. And another thing to keep in mind is that from this low, the price started to go up, and then it's looking like it's rejecting back down. The only way it can break below the swing low is that it first needs to break this internal low. If this smaller internal low breaks down, then we also validate a new lower high. This won't impact the setup in any way. In fact, it's supporting the direction of the setup, because as long as the price keeps holding this pattern of lower highs and lower lows, eventually we will also get a break of the swing low that was planned for the sell setup. The only thing we need to be aware of is the formation of this low as a higher low, because if the next low also ends up higher, so basically it can't break below this low into a lower low, but it ends up on a higher low, then there's a good chance the trend can reverse into an uptrend. And if that happens, we get stopped out. So the key swing point at this moment is this low. That low broke down into a lower low from here, and also a lower low from the swing point, which closed the setup on the take profit. Now if we analyze the last points, we have that higher low that we've talked about, and also a validated new lower high. That lower high was followed with a push to the downside that broke the previous higher low and turned it into a lower low. Now again, it's confusing because we have bullish swing points, being the higher low, but we also have bearish swing points, being the lower low that it created from the last downside movement. And again, the best thing to do in that case is to just wait for more price action. For example, from the last lower low, the price started to push to the upside, so a break of the previous high means that we now have a higher high, and it's actually the very first higher high. After the first higher high prints on the chart, sell structures like supply zones will no longer respect, so it doesn't make sense to look for sell setups anymore. And that's because when the market was previously forming lower highs, but then it forms the first higher high. That higher high is what signals a trend change. And since the market was previously following a downtrend, the trend change is a shift into an uptrend. On uptrends, we stop looking for supply zones, but instead we now look for demand zones. They are the last candles on a swing low where the market has started to impulse to the upside. That impulse must break above the last high, so it can create a higher high. That's a key important part, because if you look here, for example, and we take a demand from here, you will see that the market actually hit the demand and has initially bounced to the upside, but that was short-lived because the price quickly dropped and broke down this demand. This demand did not respect because it was not valid in the first place. For a demand to be valid, the market needs to fill the demand from a higher high and not from a lower high. Just like it happened here. So we didn't have any bullish sign at this moment to validate a demand. That's why you don't need to force setups or try to predict the reversal. And it might be a better idea to have patience and let the price show more clarity. We only react. We don't try to predict. And now that we have the first higher high, demand levels should validate. Keep in mind the uptrend is formed from a constant repetition of higher highs that are then followed with a higher lows. So if we have a higher high here, the upcoming swing point should be a higher low. That's basically seen as downside pullback that is not able to break the last low, but instead it needs to end somewhere above it. The level it should end is inside of a demand level. So we identify the demand on the last low, which is around the last candles before the market pushed to the upside, somewhere around this level. And since we expect the downside pullback to end inside this level before continuing the uptrend, that means that we can take advantage of this with a buy setup from the demand, stop loss below the last low, because we don't expect a lower low on an uptrend, but as I said, it needs to end on a higher low, so it can then continue the uptrend with a higher high. Again, we are not trying to predict. We only follow the trend and the swing points the market has been forming. Essentially, we hope for continuation of the trend. And if we look for uptrend continuation, it makes sense for the take profit to be placed above the previous high, expecting a higher high. Now, if that higher high has a low risk-reward ratio, then we target for a higher level, pretty much above one of the last lower highs. For example, above this level, the ratio increases to about 1 to 2, and we can target for slightly more. So that means that we look for the other lower highs, usually until we get a 2 or 2.5 ratio. That's not high but also not low, but it's more than enough. Price pulls down and hits the demand, which means that the buy setup gets opened. The market bounces to the upside shortly after, then it holds this bullish momentum until eventually it breaks above the last high, closing the setup on the take profit. So what we did is to only follow what the trend has been saying. We saw that the market started forming an uptrend pattern, and so we reacted to it instead of trying to predict it. Rewatch the video, understand each step as best as you can, and you will likely see an improvement in your winning setups. But also remember that winning is not enough. What actually matters the most is keeping those wins and not losing them back, which is basically where we put our focus on the program that you can find on the description of the video, if you're interested about it. And also have a great trading week.